Let's talk about something that no one else is talking about. The total return equation shift that has happened over the last 18 months. So total return, what does that mean? So when you're talking about performance in the context of an investment portfolio, total return is broken down in two parts. One is the income piece. So think dividend income, bond interest income. That makes up the income component of total return. Income plus appreciation of your portfolio assets equals total return. So let's think back to 2016, which I'm going to share my screen here and show you the Fed funds rate back in 2015, 2016. And we'll talk about the total return equation in a zero rate environment, which the Fed funds rate was at about 0%, as you can see here. Okay, so if I'm a investor, a balanced portfolio, I've got a mix of stocks, a mix of bonds, and I'm a retiree, and I'm breaking down the components of total return in that zero rate environment, it might look something like this. On the income side, I might get a little dividends from my stock investments, but still, that's not a meaningful piece. That's probably less than 1%. Bond yields were under 1% in many parts of the yield curve. So for simplistic purposes, let's call the income piece back in 2016 1%. I think that's being generous. Which means if I'm targeting a total return of 6%, let's say, and I'm getting 1% in income, I need 5% in appreciation to hit my total return target. So zooming out in that environment, someone might look at bonds and say, these yields are pretty paltry. I might shovel more money into the S&P 500. I'm getting some dividend income. I have the opportunity for my stocks to go up in value. But it was a very unbalanced equation, almost zero in income or paltry income and relying exclusively on the appreciation of the assets. Okay, fast forward to 2023. That equation looks much different and it's much more balanced. And if you are a reasonable investor, a balanced investor, and you're investing in bonds and stocks, it's the most attractive setup potentially in 10 plus years. So let's talk about the total return equation in 2023. Let's start with the income side. The 10-year treasury right now is yielding 4.8%. A one-year U.S. Treasury is yielding over 5%. Okay, you're still getting some dividend income. So let's conservatively say on the income side of the total return equation in 2023, we can get 3%. Okay, let's stick with our 6% bogey, which is just made up our 6% total return target of 6%. I said that twice. Let's stick with our total return target of 6%. So we've got 3% income plus now 3% appreciation of the assets. So notice how balanced that is. 3% income, 3% appreciation equals a total return of 6%. Compare that to the 2016 version, almost nothing in income, exclusively relying on the appreciation of the assets to reach our total return target. So again, the journey from going from 0% rates to 5+% Fed funds rate has been painful. But once the Fed pauses, things stabilize. This is a decent environment for savers, investors, retirees, those looking to generate portfolio investment income. Fixed income has not had income for over a decade. So this is more of a normal rate environment. I think we got addicted to low rates and it kind of skewed some folks' asset allocation to potentially be taking more risk than they set out to, or buying a junky stock just because it paid an 8% yield. So again, once things stabilize, this total return equation is much more attractive than it's been in roughly 10 years. Thanks for watching. Thanks for listening. We'll see you next time.